When the great machine cracks, its keepers always promise they have the solution. They roll out remedies with impressive names, pledge the realm's treasure, and assure everyone that stability will return. The 2008 mending was supposed to be different. The politicians called it the Emergency Economic Stabilization Act. The inner circle called it salvation. The villagers called it a robbery. But here is the truth. Nobody wants to whisper it did not actually solve anything. It just bought time. And that time is running out. The Troubled Asset Relief Program, a grandly named potion, was sold as a $700 billion lifeline to prevent the machine's collapse. The chief alchemist stood before the council and warned that without immediate action, the entire machine would crumble. The gears would fail, the flow of credit would freeze, and the people would lose everything. The fear was real. The panic was genuine. But the solution was a band-aid on a severed artery. And now the bleeding is starting again. What made 2008 terrifying was not just the scale of the crack. It was the realization that the institutions everyone believed in were hollow. Great houses that had existed for over a century vanished in days. Giants that seemed too big to fail collapsed overnight. And the Federal Reserve, the high keepers meant to prevent such disasters, had to admit they were out of conventional magic. The machine that promised safety had become a house of cards. When the wind blew, everything toppled. But here is the part that should haunt your sleep. The rescue did not fix the underlying flaws. It papered over them. The towers that were too big to fail in 2008 are now even bigger. The elixir of debt that was unsustainable then has exploded to levels that make the previous crisis look manageable. And the Keeper's ability to mount another rescue has been quietly but systematically destroyed by the very policies that were supposed to prevent the next collapse. The numbers tell a story the Keepers would rather you ignore. When the potion was first authorized, the realm's debt stood at roughly $10 trillion. Today, it has nearly quadrupled to over $38 trillion. Interest payments alone now consume more of the realm's budget than all its shields and spears. Every day, the Keepers borrow more gold just to pay the interest on gold they have already borrowed. This is not governance. It is a Ponzi scheme dressed in robes of state. And unlike 2008, when the alchemists could cut interest rates to near zero and print money without consequence, the spells that saved the machine last time are either broken or unusable. Interest rates have already been raised to combat the fever of inflation, leaving little room to cut them again. The money supply has been expanded so dramatically that printing more risks destroying the currency's very essence. The magic that policymakers relied on during the last crisis has been spent, and the enemy is marching toward the gates again. What is coming in 2026 is not just another storm. It is the reckoning for 16 years of kicking the can down the road. Every bailout, every stimulus, every emergency spell since 2008 has made the machine more fragile, not stronger. The towers that were saved became more reckless, knowing they would be rescued again. The Keepers became addicted to spending beyond their means, confident that someone else would always buy their paper promises. And ordinary people were told that rising illusions meant prosperity, even as their wages stagnated and their cost of living soared. The warning signs are already flashing. Corporate debt has reached record levels, much of it in the form of risky loans that would not have been made in a saner era. The great commercial towers are collapsing as office buildings sit empty and retail spaces go unleased. The smaller banks are failing at a pace not seen in ages. And inflation, which was supposed to be a passing shadow, has become embedded in the economy like a parasite feeding on the host. But the most dangerous element is not visible. It is the loss of faith in the machine itself. In 2008, people still believed the Keeper's intervention could work. They trusted that the alchemists knew what they were doing. They had faith that the realm's leadership would find a way through. That faith has been shattered by years of failed spells, political dysfunction, and the growing realization that the people in charge are either lost or corrupt. When the next crisis hits, and it will hit, the usual playbook will not work. The Council will not be able to authorize another massive bailout because the realm's credit is already stretched to the breaking point. The alchemists will not be able to print their way out of trouble because the fever is already raging, and the currency's status as the realm's standard is under assault from rivals who see the weakness. And the people will not accept another rescue of the inner circle, while the villagers suffer because they have learned that the benefits of these spells flow upward while the costs flow down. This is not pessimism, it is arithmetic. When you borrow your way out of a debt crisis, you do not solve the problem, you make it bigger. When you save institutions that should fail, you do not create stability. You create moral hazard. And when you promise that this time is different while repeating the same mistakes that caused the previous disaster, you do not inspire confidence. You guarantee catastrophe. The 2000 rescue plan worked in the narrow sense that it prevented an immediate collapse. Banks were refilled, markets were calmed, and the economy eventually recovered. But it worked the way a painkiller works for a broken bone. It numbed the pain without healing the injury, and now the bone is shattered beyond repair. What makes 2026 different is that the injury has metastasized. The problems that caused the 2008 crack have grown larger, more complex, and more interconnected. The solutions that worked then are no longer available, and the political will to implement painful but necessary reforms has evaporated in a cloud of partisan gridlock and special interest capture. The realm's fiscal position has deteriorated so dramatically that it can no longer credibly promise to backstop the machine. Foreign lenders who once eagerly bought the realm's debt are now hedging their bets, diversifying into other currencies and assets. Domestic lenders are demanding higher yields to compensate for the increasing risk that the keepers might not be able to honor their obligations. And the very institutions that were saved in 2008 are now so large and interconnected that their failure would be even more devastating than it was 16 years ago. This is the trap that every empire eventually faces. The cost of maintaining the machine grows faster than the machine's ability to generate wealth. The debt required to fund today's comforts crowds out investment in tomorrow's strength. And the political pressures to maintain the status quo prevent the reforms necessary to restore sustainability. Rome faced this trap. Spain faced it. Britain faced it. And now America is staring into the same abyss. The question is not whether the machine will fail. The question is what happens when it does. Because unlike previous crises where failure was followed by recovery and reform, the next collapse might not offer a second chance. The resources needed for reconstruction might not exist. The international cooperation required for stabilization might not be available, and the social cohesion necessary for collective action might have already dissolved in a toxic stew of inequality, polarization, and despair. The parallels to history's greatest fables of collapse are impossible to ignore. Every dying empire tells itself the same lies. Every failing system insists that this time will be different. But the mathematics of collapse are ruthless, and they do not care about political promises or economic theories. When debt grows faster than the ability to service it, when money loses its anchor to reality, when institutions become too corrupt to function, the outcome is always the same. The only variable is timing. America in 2026 will face what the alchemists politely call a liquidity crisis. But that sanitized language obscures the brutal reality. When the keepers can no longer borrow at reasonable rates, when foreign lenders start demanding real assets, instead of paper promises, when domestic savers realize their bonds are worthless IOUs, the entire structure comes apart. Not gradually, but suddenly. not partially but completely. The Federal Reserve's Great Ledger tells the story in numbers that should terrify anyone who understands what they mean. In 2008, the Fed held roughly $800 billion in assets. Today, that number approaches $8 trillion. The central bank has become the buyer of last resort for paper that no rational investor would touch. This is not policy. It is financial alchemy. And like all alchemy, it promises to turn lead into gold while delivering only smoke and mirrors. When the 2008 crisis hit, the Fed could expand its ledger because it was starting from a relatively clean position. There was room to maneuver space to absorb losses' credibility to burn. But 16 years of emergency measures have consumed all of that flexibility. The central bank is now so leveraged, so exposed to toxic assets, so dependent on continued confidence in its solvency, that any serious shock would expose its fundamental insolvency. And the shocks are coming. China is actively working to replace the dollar as the world's standard, creating alternative systems and encouraging its trading partners to settle transactions in yuan or other currencies. Russia has been forced to develop similar systems after being cut off from dollar-based markets. Even America's closest allies are quietly reducing their exposure, recognizing that the currency's dominance is built on foundations that are crumbling. The repo market, a hidden plumbing system most have never heard of, but which is essential to the machine's function, is already showing signs of stress. This is where banks and financial institutions borrow money overnight using government bonds as collateral. When this market frees, as it briefly did in September 2019, the entire system seizes up. The Fed was forced to intervene with hundreds of billions in emergency lending, a preview of what is coming on a much larger scale. Corporate America has gorged itself on cheap debt, using the money not to invest in productive capacity, but to buy back shares and pay dividends. Companies that should have been allowed to fail during the pandemic were kept alive with government loans and Federal Reserve bond purchases. The result is a zombie economy filled with enterprises that cannot generate enough cash flow to service their debts, but are prevented from failing by artificial life support. The commercial real estate sector is particularly vulnerable. Office buildings across America sit empty as companies embrace remote work. Retail spaces remain vacant as consumers shift to online shopping. The loans that finance these properties are coming due, and the buildings are worth far less than the debt they secure. Regional banks, which hold much of this commercial real estate debt, are facing losses that will dwarf the savings and loan crisis of the 1980s. State and local governments are equally fragile. Pension promises that were underfunded during good times have become impossible to meet as investment returns disappoint and retirees live longer than expected. Cities and states that borrowed heavily to fund current operations now face a choice between defaulting on their bonds or cutting essential services. Either option leads to social unrest and economic disruption. The international dimension makes everything worse. In 2008, foreign central banks coordinated their responses, providing dollar liquidity to their domestic banks and maintaining stability in currency markets. But the geopolitical landscape has changed dramatically. America's relationships with China and Russia have deteriorated to the point where cooperation is impossible. European allies are focused on their own problems, from energy shortages to migration crises to the ongoing fallout from Brexit. When the next crisis hits, America will face it largely alone. The network of swap lines and cooperative agreements that helped stabilize the global machine in 2008 may not be available. Foreign central banks may decide that protecting their own currencies is more important than supporting the dollar, and without that international cooperation, the collapse will be faster and more severe. The psychological element cannot be ignored. Markets run on faith, and faith in American institutions has been steadily eroding. Each failed promise, each missed target, each emergency spell that becomes permanent policy chips away at the credibility that underpins the entire system. When that credibility finally snaps, the unwinding will be vicious. Unlike 2008, when most Americans still believed their keepers could solve any problem with enough gold and political will, the next crisis will unfold against a backdrop of deep skepticism about official competence. The response to the pandemic, the chaotic withdrawal from Afghanistan, the inability to control inflation or secure the border have all contributed to a growing sense that the people in charge don't know what they're doing. This loss of faith is not just domestic. Foreign investors who once viewed American assets as the safest store of value are now questioning that assumption. Sovereign wealth funds are diversifying away from dollars and treasury bonds. Central banks are accumulating gold at the fastest pace in decades. Even pension funds and insurance companies are reducing their exposure to long-term government debt. The feedback loops are accelerating. As foreign demand for American debt decreases, the government must offer higher yields to attract buyers. Higher yields increase the cost of servicing existing debt, requiring even more borrowing. More borrowing reduces faith in the government's ability to repay, which requires even higher yields. This is the death spiral that has claimed every over-leveraged borrower throughout history, from individual homeowners to entire nations. What makes this moment unique is the scale and interconnectedness of the global machine. When banks failed in the 1930s, the damage was largely contained within national borders. When the 2008 crisis spread internationally, central banks still had the tools and credibility to respond. But the next collapse will unfold in a world where debt levels are higher. Policy tools are exhausted and international cooperation has broken down. The rescue plan that worked in 2008 required three things: massive government spending, central bank money printing, and international coordination. All three are now impossible or counterproductive. Government spending would accelerate the inflation fever and undermine faith in the currency. Money printing would have the same effect. And international coordination is blocked by geopolitical rivalries that didn't exist 16 years ago. This leaves America facing a crisis with no viable solutions, only increasingly desperate measures that will make the eventual collapse more severe. The government will try the same playbook that failed everywhere else throughout history, and the results will be just as predictable. Price controls will create shortages. Currency manipulation will destroy what remains of the dollar's credibility. And attempts to force compliance through regulation will drive capital underground or offshore. The banking sector that emerged from 2008 supposedly stronger is actually more fragile than ever. Concentration has increased dramatically, with the largest institutions now controlling an even greater share of total assets. The top 5 banks hold more deposits today than the top 10 held before the crisis. This concentration was supposed to create stability through diversification and scale. Instead, it has created systemic risk on a level that makes the previous crisis look manageable. These mega banks have used their government-backed advantages to crowd out smaller competitors and take on risks that would have been unthinkable in a truly competitive market. They know they will be saved again, so they behave accordingly. Trading desks that should have been shut down after 2008 are larger and more leveraged than ever. Derivatives positions that contributed to the last meltdown have grown exponentially, and the complex interconnections between these institutions mean that the failure of any one could trigger a cascade that brings down the entire system. The shadow banking sector, which includes money market funds, hedge funds, and other non-bank financial institutions, has exploded in size since 2008. These entities perform bank-like functions without bank-like regulation or guarantees. When stress hits the system, they are the first to run for the exits, amplifying any downturn. The repo markets they depend on for funding can freeze overnight, leaving them unable to meet their obligations. Meanwhile, the real economy that all of this financial sorcery was supposed to serve has been hollowed out. Manufacturing jobs have continued to migrate overseas. Infrastructure has deteriorated to the point where basic services can no longer be taken for granted. Innovation has been concentrated in a handful of technology companies that create wealth for their shareholders while eliminating jobs for everyone else. The social contract that held the realm together during previous crises has been shredded by decades of rising inequality and declining opportunity. The middle class that once provided stability and legitimacy to the system has been squeezed between stagnant wages and rising costs. Young Americans face the prospect of being worse off than their parents for the first time in generations. And older Americans watch their retirement savings evaporate in real terms while their elected representatives promise solutions that everyone knows are impossible. This erosion of social cohesion matters because successful crisis management requires collective action. In 2008, Americans grumbled about bailing out the inner circle, but ultimately accepted it because they believed the experts knew what they were doing. That trust is gone. The next rescue attempt will face massive resistance from a population that has learned the hard way who benefits from these programs and who pays for them. The political system that would need to authorize and implement any rescue plan is itself in crisis. Congress can barely pass basic spending bills, let alone comprehensive financial reform. The Federal Reserve's independence, which was crucial to its effectiveness in 2008, is under attack from both parties. State and local governments are focused on their own fiscal emergencies, and the international partnerships that provided crucial support during the last crisis have been replaced by trade wars and strategic competition. Foreign creditors who financed America's recovery from 2008 are now competitors rather than partners. China, which helped stabilize global markets by continuing to buy treasury bonds during the worst of the crisis, is now actively working to undermine dollar dominance. Japan and European allies are dealing with their own financial stress and may not have the resources or political will to support American markets. Oil-producing nations that once recycled their export earnings into dollar-denominated assets are exploring alternatives. The demographic trends make everything worse. An aging population requires more healthcare and social services, just as the working-age populations that funds these programs is shrinking. The baby boom generation is moving from its peak earning years into retirement, reducing tax revenues while increasing spending obligations. Immigration, which could help offset these trends, has become a political lightning rod that prevents rational policy responses. Climate change adds another layer of complexity that didn't exist during previous financial crises. Extreme weather events are becoming more frequent and more costly, straining government budgets and insurance systems. The transition away from fossil fuels requires massive investments in new infrastructure, while potentially stranding trillions of dollars in existing assets. And the international cooperation needed to address climate challenges is being undermined by the same geopolitical tensions that will make financial crisis management more difficult. The technological landscape has also changed in ways that make crisis management more challenging. Social media can amplify panic and spread misinformation faster than ever before. Algorithmic trading can accelerate market crashes beyond human ability to intervene. Cryptocurrency markets, which didn't exist in 2008, add new sources of instability and channels for capital flight. And cyber attacks can disrupt financial infrastructure in ways that traditional policy tools cannot address. All of these factors are converging toward a perfect storm in 2026. The economic expansion that began after 2008 is already showing signs of exhaustion. Corporate earnings are declining, unemployment is rising, and inflation remains stubbornly high despite repeated promises that it would be temporary. The yield curve has inverted historically a reliable predictor of recession. Consumer confidence is falling as household budgets are squeezed by rising costs and stagnant incomes. The trigger could be anything: a major bank failure, a sovereign debt crisis, a cyber attack on financial infrastructure, a geopolitical shock that disrupts global trade. The specific catalyst matters less than the underlying fragility of the system. When faith breaks, the unwinding will be swift and merciless. Markets that took years to recover from 2008 could collapse in days or weeks. The human cost will be staggering. Millions of Americans will lose their jobs, their homes, their savings, and their hope for the future. The social safety net that provided some protection during the last crisis has been weakened by years of budget cuts and political gridlock. State and local governments already struggling with their own fiscal problems will be able to fill the gaps left by federal inaction. The international ramifications will be equally severe. Emerging market economies that depend on dollar financing will face capital flight and currency collapses. Developed nations with their own debt problems will be forced to choose between supporting their domestic economies and maintaining international stability. Global trade, already disrupted by protectionist policies and supply chain fragility, could collapse entirely. This is not a distant threat or an abstract possibility. The mechanisms of collapse are already in motion. Debt levels are unsustainable and growing. Asset bubbles are expanding beyond any rational measure of value. International tensions are escalating toward open conflict, and the policy tools that might address these problems are either exhausted or politically impossible to deploy. The 2008 rescue plan bought time by transferring private losses to the public ledger. But time is not a solution when you use it to make the underlying problems worse. Every year since 2008 has added more debt, more risk, more complexity, and more fragility to a system that was already on the brink of collapse. The reckoning has been delayed, not avoided, and when it comes, it will be more severe than anything in living memory. The warning signs are everywhere for those willing to see them. The only question is whether you will be among the few who prepare for what is coming, or among the many who trust in promises that history has already proven to be lies. Because one thing is certain, the next crisis will sort the prepared from the unprepared with ruthless efficiency. And there will be no magic cavalry riding to the rescue. The mechanics of collapse are already visible to anyone who understands how financial systems actually work. Corporate borrowing has reached levels that would have been considered insane just a decade ago. Companies are issuing bonds not to fund growth or innovation, but simply to refinance existing debt at slightly lower rates. This is the classic sign of a Ponzi scheme reaching its final stages, when new money is required just to service old obligations. The derivatives market, which nearly destroyed the global economy in 2008, has not been tamed or reformed. It has metastasized. The notional value of outstanding derivatives contracts now exceeds $1 quadrillion, a number so large it defies comprehension. These financial weapons of mass destruction are concentrated in the hands of the same institutions that required bailouts 16 years ago. Only now they are bigger, more interconnected, and more systemically dangerous. Regional banks across America are sitting on hundreds of billions in unrealized losses from bonds they bought when interest rates were near zero. As rates rose to combat inflation, the value of these bonds collapsed, creating paper losses that become real the moment depositors demand their money back. Silicon Valley Bank was just the beginning. A preview of the wave of failures that will sweep through the banking sector when faith finally breaks. The repo market that keeps the machine's plumbing functioning is showing increasing signs of stress. Overnight lending rates spike without warning, forcing the Federal Reserve to intervene with emergency liquidity injections that have become routine rather than exceptional. Each intervention is larger than the last. Each crisis requires more dramatic measures, and each temporary fix creates the conditions for an even more severe breakdown. The 2008 rescue plan did not save the system. It broke it more completely than any crisis in American history. When 2026 arrives, there will be no cavalry, no bailouts, no magic solutions, only the brutal mathematics of collapse and the sorting of those who prepared from those who trusted in lies. History does not repeat, but if you ignore its warnings, it will crush you all the same.